Welcome back. Volatility in the Asian markets as we speak. Remember when we started the show, majority of the Asian indices were in the green, and now that seems to have sold off. So we have the Nikkei now, which is in the red. The Hang Seng that opened with a gain of about 200 points immediately gave up 250 points and currently sitting with a cut of about 50 points. The Shanghai too is off its high point of the day. Let's take a look at the other indices as well, and let's see whether they've gone off the high point of the day as well. Remember, the Korean index was sitting with a cut of about 0.2%, now down about 0.3%. The Straits as well as the Taiwanese indices too of the high point of the day. In that regard, the SGX Nifty, which was indicating a start of about 13 points in the green, has now moved to the low point of the day, indicates a flattish start. So this is something that we will be watching out for through the course of the day. Now, the government is calling for new measures to improve liquidity in the system, but is a cut in the cash reserve ratio an option before the central bank? Lata Venkatesh caught up with Anant Narayan, the money market expert as well as professor at SP Jain Institute of Management, to discuss this further, and began by asking the key question: is CRR cut an option?
It's a tricky one. Obviously, with oil prices coming down and with CPI remaining as soft as it has, the degrees of freedom that policymakers have increased. But I would, probably suggest that we need to exercise some caution out here. Look, what's the intention and what's the objective that we are searching for here? Yes, money has to go to certain sectors which are facing stresses, NBFIs, for instance. Now, there it's not a question of cost of money. Do we really want cost of money to come down, or are we just ensuring that liquidity is available to them at a particular price, at the right price? Now, if the latter is the problem, then it's to ensure that the solution is to ensure that the banking system has adequate capital to be able to lend money to these sectors at the right price. And as you rightly pointed out, RBI is making money market liquidity available. Now, if you're saying, no, it's not just enough to produce liquidity or provide liquidity, the overall lending has to go up and we need to bring down interest rates as well, then of course you can bring in a CRR cut question as well. But I suspect we're not there as yet. Look, while we are celebrating the fact that oil prices
let me make a case for it, Anant.
Sure.
It is difficult for the Reserve Bank maybe to cut rates now because they've just moved into calibrated tightening, just last policy. On the other hand, since the last policy, crude prices have fallen by 25%, and that has strengthened the rupee from 74.5 around the time the policy was announced to 71.5 now. So the inflation trajectory probably has to be redrawn by all economists. And since you can't cut rates, what is the objection at all to a CRR cut? One more argument. The Reserve Bank anyway is providing 40,000 crores of liquidity by buying bonds in October and November. Now, if you do too much of buying bonds, you impact the yield curve a little too much. Is not this another way of providing liquidity?
Very valid arguments, Lata, and I'm not saying you're wrong. All I would provide as a counter is, look, just a month back we were worried about overheating in the economy as far as concerned. We were worried about trying to curtail demand so that imports come down, so that the external sector stress that we have of a high current account deficit is controlled. Yes, we are celebrating lower oil prices right now, but can you be sure that this is not ephemeral? December 7th, you have an OPEC meeting. Do you want to go like a yo-yo up and down in the overall context of a very volatile global system? Let's not forget, we are also an emerging market. If there are global trade wars, if there are geopolitical stresses, the luxury that we have of cutting rates and bringing down rates is not as much as a developed market like US does. We have to be concerned about our own separate stresses. All I would say is that, yes, there is room within the policy framework for an easing of the overall policy framework. We obviously don't need to hike rates at this point in time. But do we really want to bring down overall rates at a time when banking loans are still under stress? At a time when we don't know what the true asset quality of NBFIs is? At a time when, capital, if you ask me, the real solution is bringing in adequate capital. We are probably trying to solve a capital problem and therefore a risk appetite problem by injecting liquidity into the system. It's, again, I think it's the wrong solution to the right problem.